Next, let us look at the trading and settlement process in stock exchanges, which is how stock exchanges actually work. Once upon a time, when stock exchanges were still new and not tech driven, buying and selling of shares happened right on the stock exchange floor. Back then, there was something called the open outcry system or the auction system. Imagine a chaotic room filled with lots of brokers taking orders from their clients, then shouting out the prices that they wanted to buy or sell the shares at. Other brokers would respond by shouting back with their own prices, either accepting or proposing new prices. It was very loud, fast paced, and intense. But fast forward to today, and it is a completely different scene. The trading has moved from the noisy exchange floor to the calm and quiet of a broker's office or onto your own desktop. Now, everything is done through an online screen based electronic trading system. All the buying and selling of shares and debentures is managed through computer terminals that are directly connected to the main stock exchange servers. So, no more shouting, just clicks and numbers on a screen. Let us break down the trading and settlement process in the stock market using this simple flowchart. Imagine you have a buyer on one side and a seller on the other side. Individuals cannot directly trade on the stock exchanges, and all trading is done through registered brokers who are connected to the stock exchange. So we have broker 1 for the buyer and broker 2 for the seller. The buyer places an order to buy shares through broker 1, and this order goes to the stock exchange. The stock exchange then matches this order with a selling order from broker 2 and connects the buyer and the seller. Once the trade is confirmed, the buyer's money flows from the buyer's account to broker 1's account and then to the clearinghouse, and from there to broker 2's account, who then sends it to the seller's bank account. The shares move in the opposite direction, from the seller's demat account to the broker 2's demat account. From there, it goes to the clearinghouse and the depository, then to the broker 1's demat account, and finally to the buyer's demat account. Clearinghouses are like middlemen who make sure that the buyer gets the shares and the seller gets their money. Examples include the Indian Clearing Corporation and the NSE Clearing Limited. Depositories are like banks for your shares. All demat accounts are actually opened in a depository. The two main depositories in India are CSDL, that is Central Depository Services Limited, and NSDL, National Securities Depository Limited. The depositories are constantly connected to the clearinghouses. Active stock exchanges in India, where all this trading happens, include the Bombay Stock Exchange or BSE, known for the Sensex, NSE or National Stock Exchange, known for the Nifty Index. There are some other exchanges also, like the Calcutta Stock Exchange, Multi Commodity Exchange, and many more. But they are either specialized exchanges for specific types of securities, or they are very small. And to trade on these exchanges, you will need a broker. Some of the top brokers include Zerodha, Upstocks, ICICI Direct, HDFC Securities, Angel Broking, and many more. So this is a quick overview of how money and shares flow in the stock market and who are the main players. Just to add, this flowchart is a simplistic version. There are many more steps and there are more links in the full process. But for the purpose of this discussion, I have tried to keep it simple.